Titanic couldn't swing it, but like a big boat on a collision course with an iceberg, Canada's economy veered, avoiding a technical recession. The latest data from Statistics Canada shows GDP growth of 2.6% in the third quarter, way more robust than economists expected. Analysts say it looks good on paper, but
It's not a recession, but it's tough out there.
GDP was bolstered by a housing market that perked up.
There's been policies by the federal government and provincial governments around the country to boost housing supply. Lower interest rates compared to a year ago are also helping the housing market.
Increased government spending on defense also did the heavy lifting. But a big drop in imports, what businesses spend to bring things into the country, made third quarter growth seem a lot rosier than it actually was. And those trade numbers aren't final. They'll need to be reviewed because that data comes from U.S. Customs. And the longest government shutdown in American history forced our national data agency to guesstimate imports.
We're missing September's data points. So Statistics Canada then had to infer what that number could be.
Another cause for concern, people from coast to coast to coast pulling back on spending, and business spending was flat.
We did not see very strong final domestic demand in the third quarter. In fact, it was non-existent. It was flat. And so that's concerning. It goes to show you that the Canadian economy still is in trouble.
All of this has big implications for the Bank of Canada. Its next interest rate announcement is December 10th, and most investors and economists expect the central bank to hold and continue to hold its key policy rate at 2.25% well into 2026. Gaviola, Global News, Toronto.